Hello and welcome. Moss Adams is pleased to present today's webcast, Navigate IRS Form 990 with Confidence, to members of Philanthropy California. Before we begin, I'm going to play a brief housekeeping video.
Welcome, and thanks for joining us. We're pleased to present another in our ongoing series of continuing professional education webcasts to help companies and individuals conquer challenges as they plan for what's next. Our presentation will start in a few moments. Before we begin, here are a few things to keep in mind. You can customize how you both view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can also adjust window size and placement or enter full screen mode using the controls at the top of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons, each relating to a different aspect of our session. You can download the group attendance sheet and a PDF copy of today's slides from the slide deck and handouts widget to the right of the slide view. You can ask our presenter questions during the webcast by typing a question in the Q&A window below the slide view and clicking Submit. We'll do our best to answer all questions during the presentation or follow up via email. If you experience technical difficulty during today's presentation, refresh your browser by hitting the F5 key. Today's session will offer you 1 CPE credit. To receive credit, you must meet the requirements as specified by the National Association of State Boards of Accountancy. You must attend at least 50 minutes of the session and respond to at least 75% of the polling questions, which we'll ask throughout today's presentation. To respond to a poll, click the button next to your answer. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget to open a PDF file that you can save to your computer. Don't worry if you can't download your PDF certificate today. We'll email a copy to you in 2 weeks. If you're attending this webcast in a group, you must complete our attendance sheet to receive CPE credit. The attendance sheet is available in the slide deck and handouts widget. Please have all group members sign it and send only 1 sheet per group. Also note that CPE credit can be awarded only to participants registered as themselves and isn't available to participants who view the on-demand version. As a reminder, the presentation you're about to see isn't legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I'm pleased to introduce Cameron Green, Vice President of Professional Learning and Family Philanthropy at Southern California Grantmakers.
Thank you, Amy. Good morning, everyone. I would like to extend a welcome on behalf of Philanthropy California, which includes Northern California Grantmakers and Catalyst of San Diego and SCG's Professional Learning Suite, Evolve. We are delighted to partner with Moss Adams for another exciting financial literacy program. And I'd like to also take this moment to express our sincere gratitude for this continued partnership. Thank you for joining us, and we hope that you enjoy today's program. With that, I'll hand it back over to you, Amy. Thank you.
Well, thank you, Cameron. It is nice to have you with us today. And our presentation will be given by Emina Cresswell and Jane Coleman, both senior managers here at Moss Adams. We will now turn the floor over to them to get us started.
Good morning, and thanks for having us at the introduction. I'm Emina Cresswell. I've been with Moss Adams for 15 years, so just a few years. I'm the tax co-leader of our Washington State region not-for-profit practice on the tax side. I work on tax compliance and consulting services on a wide range of non-for-profit clients, so we're delighted to be here and present to you guys, and I'm going to kick it over to Jane to get us started.
Great. Thanks, Emina. Hi, everybody. I'm a senior tax manager in the not-for-profit practice here at Moss Adams, and I've been with the firm for over 12 years now, and I specialize in providing tax and consulting services to not-for-profit organizations in various industries, including charitable and social service organizations, universities, museums, and private foundations. I'm very happy to be with you all today talking about one of my favorite topics, the Form 990. I find the 990 very interesting because it serves a few purposes. First, it helps the IRS evaluate whether your organization is operating properly according to its exempt mission and whether you're maintaining your tax exempt status. Also a great tool for the organization's board members to review for good governance purposes. And it's also a great marketing resource as well, since the 990 is a public document, so program participants and supporters and potential donors can look your 990 up on GuideStar and gain valuable information about your mission and programs and vision. So the core form of the 990 is the first 12 pages, and depending on your activities for the year, additional schedules may be required to be filed. This is the first page of the 990, and it gives readers a great snapshot of the organization. In part 1, line 1, readers can see a brief description of your mission. On lines 3 and 4 is where readers can see how many total voting members there were at the end of the reporting year and how many of them were considered independent for 990 purposes. A few reasons why a board member would not be considered independent for this purpose is if he or she was compensated, or if there was a business transaction between them and the organization, or I've seen sometimes if there are family members of the voting members working for the organization making over a certain amount. Lines 5 and 6 show how many employees and volunteers you had during the year. Lines 7A and 7B show the amount of unrelated business income you have, otherwise known as UBI. 7A shows gross UBI revenue, while 7B shows net UBI, taxable income after expenses. This is a snapshot of the second page of the 990. Part 3, line 1 is where you talk about your mission in greater detail. The difference between the language here versus the language on page 1 from the previous slide is that the language here is the official board-approved mission statement, whereas the language on page 1 is more of a summary statement to catch the reader's attention. Line 2 and 3 on this page is where the IRS asks questions about whether there were any significant changes to your programs during the year, if you've undertaken new program services, stopped conducting or made significant changes to any of your programs. And then below that, you'll see lines 4A through 4C, and this is where readers can read about your top 3 program accomplishments. And this is really a great marketing opportunity because it allows you to talk about all of the wonderful things that your organization is doing in the community. You can also see the expenses and revenue associated with each program. And the top 3 program accomplishments listed here are determined based on total expenses for each program. On the third page of the 990 is part 4, and this is where the IRS asks a lot of questions about your activities for the year. And like I mentioned earlier, depending on your activities for the year, additional schedules may be required to be filed. There are 20 different schedules that may be required to provide more information on those activities. Schedules A through R, which Emina will be going over in greater detail later in the presentation. But I wanted to highlight just a few here. There are a few questions asking about lobbying and political activities, any foreign activities, and transactions with disqualified persons, for example, foreign board members and officers of the organization. And if these apply to you, then you may need to file the Schedule C for lobbying and political activity, F for foreign activity, and L to show more detail about the transactions with disqualified persons. And again, Emina will be going over these schedules in greater detail later in the presentation. Part 5 here lists other IRS and tax compliance items that you may be required to file. For example, if you have unrelated business gross income of $1,000 or more, you'll want to make sure you're checking yes for questions 3A and 3B and filing the Form 990T. If you have foreign bank accounts, then you'll want to check yes for questions 4A and 4B and list the name of the foreign country or countries that these foreign bank accounts are located in. And make sure you're filing the Form 114 if appropriate. And questions 6A through 7H take you through additional filing requirements that you may need to do related to contributions that you receive. For example, if you receive a contribution in excess of $75, where the donor also received goods and services in return, the IRS wants to make sure that you've notified the donor of the value of these goods and services that the donor received. This tells the donor how much of it is not deductible as a charitable deduction. And if you dispose of certain property within 3 years after the donor contributed the property to you, then the IRS looks to see if you're using the Form 8282 to report such information to the IRS and to the donor. And if you've received contributions of qualified intellectual property, cars, boats, airplanes, or other vehicles, then the IRS wants to see that you're filing the Form 1098-C. So these questions are actually really helpful and act like a checklist of other filings that you may be subject to. I wanted to highlight questions 15 and 16 in Part 5, which are fairly new. These two questions were added to the 990 a few years ago as a result of the Tax Cuts and Jobs Act of 2017. Question 15 asks if you are subject to the excise tax on payments of remuneration or excess parachute payments in excess of $1 million. And question 16 is asking if you are an educational institution subject to the excise tax on net investment income. Moving on to Part 6, Section A. The questions here show readers information related to the characteristics of your governing board. It talks about whether there were any family or business relationships between any of the board members, whether there was a significant diversion of assets, who has the power to appoint the board, and if there are any governance decisions that are reserved to members other than the governing body. Section B on this page asks questions about various management policies that you have. It shows readers how you promote transparency and accountability to the public. These policies are not required per se, but it is considered best practice to have. So this list is essentially the IRS's way of telling you what policies they think you should have in place as best practice. For example, whether you have a policy on how the 990 is reviewed, and whether the 990 is made available to all board members before filing, whether you have a written conflict of interest policy, whistleblower policy, compensation review policy of how you are establishing compensation for your officers and key employees. You then explain later in the document how you monitor and follow such policies. So in general, you really want to see a lot of yes replies in this section. Part 7 is probably one of the most sensitive areas of the 990 because it lists your directors, officers, key employees, and the top 5 highest compensated employees and their compensation. And this part is open for public inspection, so the public can see this information and gauge whether it's reasonable. But all current directors and officers that served during the year are listed here, regardless of compensation paid. All current key employees also need to be listed. Key employees for this purpose are individuals that are not directors or officers. They need to be paid over $150,000, and they also need to meet the responsibility test. You also want to list the top 5 highest compensated employees paid over $100,000 that are not directors, officers, or key employees. You also need to list former directors if they received more than $10,000 of compensation in the capacity of a former director. And you also need to list former officers, key employees, and highest compensated employees who received more than $100,000. I wanted to point out that current directors, officers, key employees, and highest compensated employees for this purpose refers to folks that were with the organization at any time during the year, at any time during the reporting year. So for example, for a 2021 calendar year 990, if the individual left in October 2021, he or she would still be considered current for this purpose and not former. The amounts reported here are based on calendar year amounts, so this could get confusing for fiscal year filers. So keep in mind, if you're a fiscal year filer, you need to report calendar year amounts here on Part 7. And the ordering of the people listed here is based on total compensation highest to lowest instead of by type of position. This ordering rule is fairly new. It was put in place a few years ago, and it helps the IRS more easily identify the highest compensated individuals and determine whether you're subject to the compensation excise tax for the folks paid over $1 billion. So compensation amounts that you have to report here include base comp, other comp, retirement, and non-taxable benefits. Total reportable compensation amount received from the organization in column D or from the related organization in column E. D to tie back to that individual's W-2, the hire of box 5 or box 1. And the amounts reported in column F are employer contributions to retirement plans, non-employee, and non-taxable health benefits such as medical, dental, vision, as well as other non-taxable benefits. Which brings us to our first polling question.
All right, thank you. So our first polling question is compensation on Form 990, Part 7, Column D, should tie to which of the following amounts? A, Form W-2, Box 5 or 1, whichever is higher. B, compensation paid to employees for the fiscal year end for which the Form 990 is reporting on. Or C, neither. The organization can estimate the amount reported in column D. And we will give you a few moments to respond. To respond, please click the button next to the answer you choose and hit submit. And if you cannot see the submit button, you will just need to enlarge your slide area. It looks like responses are slowly coming in. We'll leave this up for another 5 seconds or so. Okay, here are the results.
Okay, so the correct answer is A, Form W-2, Box 5 or 1, whichever is higher, even for fiscal year end filers. So that's often it could get very confusing. But it is calendar year amounts on Part 7. Alrighty, moving on to Part 8 of the 990 Statement of Revenue. This page tells the story of how you're funded. So for example, are you funded by public donations or government grants, program revenue, investment income, or a combination of all of the above? So this page shows detailed information about your revenue streams and how it's treated for tax purposes, which is broken out into 3 different buckets: program revenue, unrelated business income, and revenue that's excluded from tax, for example, investment income. So this page gives a sense of how much of your revenue is program and how much of it is unrelated, and it helps show how if there's too much unrelated revenue, for example. But the presentation here follows the financial statements, except on the 990 we actually do not include donated service revenue, and we don't include unrelated gains or losses either. So that's the 2 differences when comparing back to the financial statements. The Part 9, Statement of Functional Expense, provides information on the organization's expenses. So this tells readers how you're spending your money. Expenses here are broken out between in three categories: program service expenses, management in general, and fundraising. Program service expenses are activities that further your exempt purpose, where management and general expenses relate to your overall operations and management. And fundraising expenses are incurred when soliciting cash and non-cash contributions. So in general, you really want to see the majority of your expenses fall in the program column. And it's also great to look at the ratio of your fundraising expenses to your total contributions received. That way, it helps you see the results of your fundraising efforts and whether it was effective. Part 10 is the balance sheet that shows detail of your assets, liabilities, and net assets, and this also follows the financial statements. So this provides insight to your organization's financial health, and you can compare a current year to prior year to see if you're trending in the right direction, and it helps you determine and identify if there are any cash flow issues. This section also provides great insight on notice restrictions on the net assets, where you can see how much of your net assets is donor restricted. There are a few new financial reporting standards surrounding revenue recognition that could affect the 990 Statement of Revenue reporting, but tax definitions for now on grants versus program revenue versus donation revenue have not changed. Also, the net assets presentation on the balance sheet, starting with the 2019 Form 990, was updated to match the financial statements. So it now reflects the new with and without donor restrictions instead of the unrestricted, temporary, and permanently restricted presentation that we had before. And functional expenses presentation for the audit in general start with the groupings that we were doing on the 990. So that's been nice to have the two match up a little bit better. So now Emina will be talking about the various schedules I mentioned earlier that you may be required to file.
Awesome. Thank you, Jane. So Schedule A, many of these organizations are public charities. And as a public charity, they have to essentially prove to the IRS that they are publicly supported and that they meet this public support test. So Part 1 of the Form 990 essentially first asks you, hey, what type of public charity are you? Goes through questions 1 through 12. One of these boxes does need to be selected to indicate to the user the type of organization that the filer is, along with which schedule that I'll talk about in a moment, which part of Schedule A you'll need to complete as well, so Part 2 or Part 3. The most common ones we see and the ones that complete Part 2 and Part 3 is those that have box 7 and 10 checked. Those are the most common ones seen, and we'll cover those momentarily. And it looks like we've got one quick question that I do want to address before I move on. There's a question to ask best practice for expense ratio for management general versus program. Before we dig a bit deeper into ratios and cover that a bit more, there isn't really a best practice. You sort of have to look at like organizations. I've heard organizations say 80-20 rule, 80% program, 20% management in general. Those tend to be a bit outdated, floating around. It might not actually be an accurate representation of the organization's activities. So you really do have to look at the organization itself, what makes sense for them. There could be a small breakdown too in fundraising column as well. So you sort of have to look at what type of organization that you're looking at, and then look at like-sized, like-type organizations to assess whether they meet those ratios that you would think they should Certainly, if you're seeing a large ratio between in the management column and less in program, I would question it and wonder, what's happening, what's going on with COVID. There are certainly some ratios that are getting skewed, just given what happened. A lot of programs needed to be shut down, for example, that couldn't occur in person, and so certainly there was more management activities in general rather than program activities that could occur. So I would say there's not a general rule anymore. I would just caution the user to read through Part 3 of the Form 990 that Jane covered to see what was the impact. There is a question on there on Part 3 that asks, did you have any changes to your program service activities? And I would read that too and see if they answer that question as yes, and what impact did COVID have to their activities, to their program service accomplishments for the year. I would expect, or I would hope that they had some sort of disclosure there to describe to the user, the reader, that they had changes to how they've done their activities. And that would give you kind of a clue that, oh, this is what happened and this is why maybe management is this year rather than last year. And I like to look at historical data too when analyzing ratios to see a little bit more of a historical trend too, as that gives you a bit of an idea as what's happening with the organization. Just like Jane mentioned, you can look at ratios by looking at fundraising, for example, over your total contributions to see if there is a way to look at what's your success rate for fundraising expenses compared to contributions revenue. And there tends to sometimes be a lag when there's, you first incur the expenses and then you want to see, hey, how successful were we with this? So having a historical trend is really helpful. All right, so that's kind of ratios at this point in time. Moving on back to Schedule A. So the ratios kind of go into play, and the public support test is really what we want to look at. Are they meeting the publicly, are they a public charity? Are they meeting their public support test? So Part 2 of Schedule A talks and is related to organizations, 509A1 organizations that receive most of their revenue from contributions. Of course, IRS likes to do math. CPAs like to do math. So it's really a mathematical test where we look at 5 years worth of data, and it calculates how large is the donor base of the organization. And it looks at and has this one line item, line 5, where it looks at excess contributors, where it limits the contributions from single sources. So it's a 5-year test that you have to look at to see, are these organizations receiving too much from one donor base that can limit their public support numerator on line 5. The key here is that the public support percentage must be over 33.33% for the prior year, current year, or if they meet the 10% facts and circumstances test. So there's little check boxes at the bottom of this schedule on Part 2 that indicates that the organization met the test for the current year, and you check that box. Or they met it last year but aren't meeting it this year, which is still fine because they're still considered a publicly supported organization. Or if they do fall below the 33.33%, they can provide this facts and circumstances test in whether they meet it for the current year or last year, and then there's a whole bunch of disclosure on Part 3, supplemental schedule and so forth. Actually, it's even further than that, not Part 3, where they describe how they meet the facts and circumstances test. So there's quite a bit of leeway on this part, how they can meet the public support test. And also, if they don't meet this Part 2 test, they could switch and complete the Part 3 test, which is typically reserved for organizations that are classified 509A2 organizations who receive most of their revenue from program service revenue and donations, so kind of a mix of both. This test is a little bit more stringent and has a bit more, I wouldn't say disqualifications, but has a little bit more computations to consider For line 7A, for example, revenue received from officers, directors are removed from the public support test. So sort of a bad fat pattern. Line 7B is program service revenue from sources that are more than 1% of your total support for the year. So again, very computational based or a formula-driven test to see if you receive too much income from a certain source. And this test also looks at how much investment income you have as an organization. So again, 33 1/3 has to come from program revenue and donations, and it has to be less than 33 1/3 from investment income. This part does not have a 10% facts and circumstances test, just like part 2, so it's a little bit more stringent. And organizations can kind of flip-flop between these two schedules based upon their fact pattern. They don't necessarily have to disclose and submit information to the IRS saying, hey, we want to switch. You can just switch to see if they could qualify for the public support test. Looks like we've got a question. We are considering granting large amounts, about 25% org budgets. We're also a private foundation. Will this impact the grantees? Yes, it will. Private foundations are considered disqualified persons for both tests, part 2 and part 3. I actually get that question quite a bit, where we have organizations that are either on the receiving end or the giving end, where they are concerned about tipping these organizations into failing their public support test. And so what sort of guidance can you provide to them? It's very individual organization based. So I think it's a good discussion to have with them. It's good to be aware that you can cause these issues for them, and definitely have some legal counsel involved if there is going to be a tipping point, because what can happen is if they fail the part 3 test, if they fail the part 2 test, and they don't meet the 10% facts and circumstances test, they could potentially become a private foundation. And so definitely something to talk with their advisors. There needs to be conversation happening and monitored to ensure that they can still meet the public support test and continue their mission. Another comment says, seem to recall that it is permissible for a nonprofit to be tipped more than 33 1/3 from one source for a couple years. That's correct. Yes, for a couple years, the test is done on a 5-year basis. So if there is just a 1 year of influx, the test is done on a 5-year basis. So if you think you're going to be getting sources from other donations that could offset that large donation, certainly, yes, there could be a point in time that you could sort of offset that. The test on part 2 and part 3, there's a box that asks, did you meet the test in the current year? Yes. Or did you meet the test in the last year? So you sort of have a 1-year catch-up year to meet your public support test in case there is a tipping event. And then, like I said, on part 2, you can also do the 10% facts and circumstances test, which usually I recommend having legal counsel involved. There are specific fact patterns. The IRS has regulations issued on that describes how they can meet this facts and circumstances test, because there is actually a large part that they have to attest to as an organization to say, yes, we actually are still a public charity, we just don't meet the 33 1/3% test. So yeah, you can certainly still be tipped, but you have to watch out which part of the Schedule A you're completing, part 2 or part 3, because part 3 does not have the 10% facts and circumstances test. But again, I advise organizations to discuss this with their tax counsel, legal counsel, to see if they can even meet that 10% facts and circumstances for part 2. So definitely a good discussion item to have with organizations, especially if you are either being tipped or you might be tipping someone. Good questions, guys. All right, moving on. Schedule B. While we're talking about donors and organizations giving donations, this part is not open to public disclosure. So what we typically do for our clients, we provide them a copy that is the public disclosure copy, which has Schedule B information omitted, such as names and addresses. But there are some states that do require this disclosure to the Attorney General. So do watch out for state filings that you might have to do, state registrations that you might have to do, or the organizations might have to do, whereby they do have to provide this. Entities other than 501c3 and 527 organizations are not required to provide donor names and addresses. Those organizations will put NA there. The general rule is that donors who donated $5,000 or more are disclosed on this schedule. Or if they meet the special rule, then these organizations are allowed to limit the listing to those donors who contributed 2% of their total contributions during the tax year. Again, kind of a mathematical test, but in order to use the special rule, these organizations have to complete Schedule A, Part 2. So, with that, on to our second polling question.
All right, our second polling question is a true or false. Some organizations can elect to limit the listing of contributors to just those donors who contributed more than 2% of the organization's aggregate contributions during the tax year. Select true or false. And as a reminder, if you would like to receive CPE for today's webcast, you will need to respond to at least 3 of the 4 polling questions that we pull up. All right, we'll leave this up a little bit longer, and don't worry about getting the correct answer. You get credit whether it's wrong or right. Okay, here are the results.
Perfect. It is true. I just covered that, so it's kind of a trick question to see if you were listening. Yes, some organizations can elect to limit the listing of their contributors by meeting the special rule rather than the general rule. So, yes, certainly nice to limit that, especially if you have a large donor base that tends to give $5,000 or more. It's nice to be able to just focus on those really large donations for disclosure purposes. Saves a bit of time on information gathering process and disclosures, and tends to get quite large if they have a lot of donors, which is nice, but becomes burdensome. All right, so going back to compensation, this schedule, Schedule J, really coincides with Part 7 of the Form 990, and this schedule is triggered if certain individuals are listed on Part 7 that have compensation of $150,000 or more, some former individuals that are also listed on Part 7, along with individuals who are paid by unrelated organizations, but you still have to disclose their compensation on Part 7 because they are typically the top financial official, top management official, etc., or someone where you just have an arrangement where someone else pays for this individual's compensation for their services that they're doing to this organization. So Schedule J can be triggered in a few different ways for completion. So Part 1 asks questions about what kind of benefits individuals that are listed on Part 7 receive. Those benefits on line 1A include first-class travel, travel for companions, gross-up payments, health or social club dues. I would say our housing allowances. Those tend to be the ones that I get to see the most occur. And then there's disclosure on Part 3 that organizations sort of have to describe what those are, who receives them, etc. So a little bit more should be seen on Part 3 of Schedule J that describes who gets what and whether it's included in their W-2 wages or not, too. And then Part 1, lines 4A and B, ask questions about severance packages and non-qualified retirement plans. Non-qualified retirement plans include plans such as 457F plans, split dollar life insurance plans, etc. So there's a few special types of plans that are considered non-qualified retirement plans that are allowable for tax-exempt organizations. And then, of course, Part 2 lists those particular individuals that have met that reporting threshold that I just talked about earlier in much greater detail than what you see on Part 7. It breaks out their compensation between base compensation, bonus and incentives, other reportable taxable compensation, retirement and deferred compensation, other non-taxable plans, etc. So it gives you just a bit more information regarding compensation to give you a sense of what's reasonable and provides you, the user, the IRS, and really anyone else, the public, a lot more information how the organization does their compensation. So moving on to Schedule L. Schedule L is transactions with interested persons. This is also a very highly scrutinized schedule because, well, you're having transactions with interested person. Kind of goes back to what Jane was saying, conflict of interest policy. How are you following it? Is it being monitored? And we just want to make sure that organizations are not getting themselves into tricky situations. However, certain things are fine, and it just requires a little bit more disclosure. So it still might be okay that they are doing those things. This just requires a bit more disclosure, such as Schedule L. So Part 2, loans to and from interested persons. There is really no reporting threshold at all. So you list the name of the interested person, the relationship, the purpose of the loan, and a bit more information about the loan itself. The typical one I see here is if they have a split dollar life insurance policy on one of their executives. Well, it's a loan, so it gets disclosed on here. So like I said, it's perfectly fine, not something that it's not permissible to do. It just needs to be disclosed. And then the part below it is business transactions with interested persons, typically in excess of $100,000. Or if there's a family member who gets compensated in excess of $10,000, this is where you would describe that. As Jane alluded to, this sometimes can be a triggering point where you have to indicate that a certain board member or an individual may not be independent because of they have someone who also works for the organization and might trigger them not to be independent, which is also fine. Just something to watch out for. All right, on to the next schedule, Schedule R. This one is also of interest to many organizations, just to see how, if they're related to other organizations and partnerships, and sort of gives you a good idea of the organizational structure of them. This is a schedule where you list related organizations, and there has to be an element of control to be considered a related organization. If there is a for-profit organization, that means more than 50% of profits or capital interest or stock ownership needs to be considered. If they are a related nonprofit organization, you look at a few different rules. In this first case, brother-sister relationship means there's more than 50% board overlap. A parent and subsidiary relationship is where you have the power to appoint the board. Or you can be a 509A3 supporting or supported organization relationship. We can probably talk in a whole hour about 509A3 organizations and how they play into it, but essentially is you can have a multitude of ways to be considered a related organization as a nonprofit, and then of course trusts if there's more than 50% beneficial interest. So many ways to be disclosed. I find them helpful. There's a lot of information described within there, in those schedules, such as total assets. Schedule R also has transactions with related organizations, quite a bit of yes and no's, and gives you just a little bit more information as a user as to what type of activities they're doing with other organizations and their overall structure. With that, third polling question.
All right, so our third polling question. Typically, for an organization to be reported on Schedule R as a related organization to the filing organization, there must be an element of control between the two organizations of what percentage? 25, 33, 50, or 80%? And while you're responding, for those of you that would like a copy of today's slides, you can download them from the folder that says Slide Deck and Handouts, and you'll also find other resources available there as well. All right, about to close this one out. Here are the results.
Awesome, thank you. So 50% is the right answer, C, to have some sort of element of control and disclosure on Schedule R. Well done, guys. Okay, all right. So what are some key takeaways about the Form 990? What activities does the organization do? What did they do during the year? Part 3, I tell my clients, this is where you tell your story. This is where you really need to talk about yourself. And then, is the organization well governed? Do you have best practices, procedures in place? And, of course, hot topic, compensation, transactions with interested persons. That one, always, people like to look at it. People like to review it. Organizations like to use other organizations' Form 990s to determine, hey, is our compensation reasonable? Are we using good metrics to, are we in line with other peer organizations for compensation? So, and then of course, is the organization financially healthy? Part 1 is really the summary page. It gives you a quick overview of revenue, expenses, and the balance sheet. The other detailed parts, Part 8 through 10, provide you with a lot more detail about the revenue sources, their expenses. You can do a lot of ratio analysis, their balance sheet, what's their total asset over liabilities, current assets over current liabilities. How financially strong are they to be able to withstand uncertainties. So you want to look at those particular parts, and they tell you quite a bit of information. With that concludes the Form 990, but there are certainly, there's a lot happening out in the NFP realm. So let's give you guys a few more tax updates, what's happening, what's going on, what's in the works. So with that, kicking it back to Jane.
Thanks, Emina. So yes, we want to spend the last remaining time together we have together on some recent tax rulings and updates. There's been quite a lot going on lately, both COVID-19 related and also non-COVID-19 related. So first, I'll start with the Infrastructure, Innovation, and Jobs Act, which President Biden signed into law back in November of 2021. And it touches on everything from roads and bridges and transportation to the country's water, energy, and broadband systems, as well as combating climate change. This bill also includes a pilot program I wanted to point out called Energy Efficiency Materials, which would fund $50 million in grants to nonprofits to make energy efficient upgrades to their facilities. So the Department of Energy would oversee this program, and it will provide grants of up to $200,000 for each nonprofit project. So nonprofits could use this funding for new HVAC units, generators, doors, windows, roofs, and lighting systems. Currently, the legislation is light on details in terms of the specific criteria required to qualify, we don't know when or how to apply for this yet. But it does say that the program will run from 2022 to 2026, and that organizations exempt under Section 501c3 can apply. And when providing these grants, the Department of Energy will be looking at the energy savings that the project achieves, the cost effectiveness when using these energy efficient materials, and the organization's plan for evaluating, measuring, and verifying energy savings, and as well as your financial need. So moving on to the Build Back Better Act. The House passed its version of this back in November, and it still needs to move through the Senate, and there hasn't been a lot of movement on it the last couple of months. So it's not final yet, but I wanted to highlight just a few provisions that's currently in the House version of this bill, just to kind of throw these out there just to think about. One item is a phase out of the excise tax on net investment income under Section 4968 for institutions providing qualified aid awards to first-time full-time undergraduate students. Other provisions include a tax credit for donors equal to 40% of contributions to certain public universities for research infrastructure, as well as making federal Pell Grants fully excludable from gross income. The current House version of this bill also created a new refundable tax credit for certain higher educational institutions as part of the Qualified Environmental Justice Program. And they're also thinking about making the American Opportunity Tax Credit available to students convicted of a felony related to the possession or distribution of a controlled substance. So again, this bill is currently working its way through the Senate and will most likely have a lot of changes. So we'll see if any of these provisions make it to the final version. And now, Emina will be talking about the ACE Act legislation as well as other tax updates.
Awesome. Thanks, Jane. All right, so the ACE Act was introduced by Senators King and Grassley in June of last year, and it was established to sort of do an overhaul of donor-advised funds and replace existing rules by creating really three types of DAFs, donor-advised funds, by creating a qualified one where there would be a 15-year payout requirement, a non-qualified one that has a 50-year DAF requirement, or qualified community foundation DAFs, whereby they can have a max value of $1 million, but that's adjusted for inflation. Really, their idea is to encourage organizations and donors to provide directly to the charitable organizations to ensure that there's no wealth accumulation in the DAFs, that they just sit there. Because what happens is the donor gives to the DAF, well, it becomes now assets of the organization that holds the DAF, but the donor gets to take a deduction right away. But it just sits there, and all they have is advisory privileges to tell the DAF, hey, I think I'd like to give it to XYZ organization. And so their concern is there's just too much wealth accumulation in these DAFs. As seen here, there's currently $140 billion sitting in DAFs, and their thoughts are to encourage those DAFs to give out to the community and to give out those funds to organizations that are in need and not accumulate that wealth. So that's kind of the thought process behind this ACE Act legislation. we're monitoring, we're looking into it. There isn't, of course, a lot of information about these out here. This is just a bill introduced, subject to change, as we all know, with Congress and the IRS, but something to keep an eye out, as there could certainly be implications and changes. One of the implications is, like I mentioned, the contributions from DAFs for determining the public support test. Currently right now, what organizations and individuals really can do is give to a DAF and get that donation deduction right away. The charity then that is on the receiving end of that DAF reports it on their Form 990 as it being a donation from, let's say, a community foundation, the sponsoring organization, another public charity, which does not impact the public support test because public charities under 509A1 are exempted from being excluded, from being limited, I should say, for the public support test. What would happen instead is these funds would have to be identified as coming from the original donor. So look through a rule, essentially, whereby that isn't really an option anymore, and that's what they're looking at, is kind of a loophole per se, not really, but that's what they're trying to get at, is avoiding that situation. So it could certainly have some tax implications for the charitable organizations receiving if it is a really large donation. So let's keep that in mind. Employee retention tax credit update. Of course, everyone's been talking about this one. Lots of changes have been happening with it. Essentially, as of September 30th, 21, that expired. Certainly options to look into, and this credit is taken on the payroll tax return, the Form 941. Organizations can amend to claim this credit if they think they can qualify for it. Different acts have changed how you qualify for it. For 2020, it's different qualification. For 21, it's a whole other qualification. Still similar, but they are different rules. We do expect to see audits of this credit. Some clients, some organizations can claim a very large credit, so we do expect there to be audits. But do keep in mind the refund timing issue. The IRS is still catching up. They're super backlogged. It could take up to several weeks, even months for certain organizations, and especially if they are claiming a large credit. So something to keep in mind. With that, we've got our last polling question related to the employee retention tax credit.
All right, thank you. So our last question is, did your organization qualify for the employee retention tax credit? A, yes, B, no, C, not applicable, or D, I don't know, should I look into it? And once you've completed all CPE requirements, you will be able to download a PDF from the CPE progress window. And since we are running short on time, we're going to go ahead and close this one out here. And here are the results.
Awesome. All right, there's no right answer on this one. It was just mostly just to get you guys thinking about this, see if there is an opportunity for your organizations and organizations that you work with to think about this employee retention tax credit and whether you can qualify. So thanks for answering that. Close it up, just a few quick updates on other provisions from a while back. IRS has now issued final regulations on pretty much all tax reform issues and provisions back from 2018. So here's a list of when they were issued. There's final regulations, so organizations have to follow them. The most welcoming one was the repeal of treating employer-provided parking as UBI. That one was just fun. Let's just say that. It was a fun one. The 990T and Schedule A was updated to reflect some of the changes as part of tax reform. They just switched some stuff up. Instead of Schedule M, they made it Schedule A to report unrelated business income. So switched things up a bit on us, which is quite all right. They made it a little bit more user-friendly to read. And then lastly, there are some electronic filing requirements. The IRS still encourages organization to electronically file. That seems to be the best method, especially now seeing and knowing what's happened with paper filings. So with that, that concludes our presentation. If you guys have any questions, please reach out. And then I think I'm going to turn it back to Amy to wrap it up.
All right, thank you. And thank you for a great presentation today. Unfortunately, we are out of time, but I do want to thank the audience for being engaged and submitting your questions to help guide the conversation. We will do our best to follow up with you afterwards if we did not get to your question. And we will also leave the webcast console open for a few minutes to give you time to download your CPE certificate. A copy will be emailed within 3 weeks should you have difficulty downloading it now. And as a reminder, if you attended today's presentation in a group and would like to receive credit, you must complete the group attendance sheet found in your console. Finally, here's a link to an online survey where you can provide feedback for today's presentation. And thank you for joining our webcast. We hope you'll join us again next time. Take care, everyone.